Okay guys, so in this video we are going to go over ICT's turtle soup pattern. Trust me guys, this pattern, if you learn this is going to take you far in this game. Trust me. Okay, so what is the turtle soup pattern by ICT, the inner circle trader? So it applies the basic knowledge of liquidity in the markets. So here you can see that we have an equal high, which is a place of liquidity for the institutions, meaning that the retail traders place their stop loss right above these two levels. So what this means is that the institutions will want to take them out of their position, leaving them with more money to take away from them. And with this pattern you will be able to play along with them, with their own positions. Okay, so the turtle soup pattern by definition means that first, when you see an equal high or equal lows form, you look for a stop hunt above or below them, and that point where it goes above or below them, that is your entry. Right here you can see right here that the entry is right above when equal highs or lows are taken out. Okay, so that is your entry. Your stop loss would be right above the last high, and your take profit would be right above the last low. Ideally you would want your risk reward ratio to be at least 3 to 1. Okay, that is a pretty important aspect of money management, which we'll need in order to keep trading and not get taken away. Okay, so this pattern forms a lot of times during the day, not in 1 week, not in a month. This pattern forms every time that you see an equal high or an equal lows. The moment you see an equal highs or equal lows, you will want to treat those levels like a magnet for the market. So you will want to know that some point of time the price is going to um, attract to those levels, and right when it takes out that level is where your entry would be. Okay guys, so this is how setting up your entry would look like. Here you go. You see these equal highs formed, then you see price coming back up to those levels. So and you see a fair value gap right there. That's an absolutely high probability entry that is as clean as it could get for you. That, trust me guys, trust me. So here you go. Place your stop loss above the last high and a little bit above that. I'm talking little. Then if you want to go down to the last low, and that is your entry right there. It's, you can see it's a 5-to-1 risk to reward ratio. It couldn't get any better guys, I'm telling you that. Right after you recognize these patterns, you will be able to take them into the markets. And you want to use these patterns with time and price theory, which means your setup would occasionally form around 8:30 New York time or 9:30 New York time, which means that right here is 8:30, as you can see 8:30 right there. Now this doesn't mean that your entry would be at 8:30. It means that your setup forms at 8:30. This is a setup, right? I told you guys, equal highs or lows plus favorite. That's absolutely a high probability setup that you want to participate in. Okay, right after the time it plays out, well, it typically you don't want to be trading after noon or after 12 o'clock. So if it forms after then, then it has a chance to not play out, to not work out. Okay, so this is time and price that you would use on this occasion. Okay, so guys, you can see that this candle's high plus you could uh, combine this with market structure, or no, I'm sorry, you would want to combine this with market structure, because the more accurate, the more things you combine it with, the more things play out, the more accurate the trade will be. Okay, so what do we see here? Okay, see, we see a bullish trend at first. Okay, you see that it's going up, right? It's going up, right? It's going up. But right here, what happens is that this is a lower high, or sorry, this is a lower high, which means that if this is taken out, there is something called a market structure shift. Okay, and here it plays out here also. I mean, you could take this trade just like you did take it the other time. Look, uh, sell side liquidity taken out, your entry would be right above the exit or take profit. I mean, I personally would put it at the equal highs, because that's where price is going to want to magnate to. Just how I said, stop loss would be right below the last low by a slide. Okay, so there is your take profit, there is your profits. I mean, guys, come on, it's as easy. I mean, the first thing, if you look at the chart, you see this, you should know that you got an entry, you got a setup that you want to be trading. Okay, so let's get back to the point of market structure. So we see this low, which is the higher low of the uptrend. As I told you, if this gets taken out, you want to change your narrative to bearish. Okay, so right as it goes up, it comes down, it retraces, it creates a lower high, but it fails to have enough power on the buy side to take out the last high, which is a normal thing of an uptrend that it does. Okay, so this is your first sign of a market structure shift, if it doesn't take out the last high. Instead, it has weak power, weak bullish power, so it goes down and takes out this low. But this is just, I mean, this is just a little bit integration of market structure shift. This is not what you want to be relied on, because as soon as it does this, goes up fast, take out the high, it could go up, go down a little bit, and just continue like it did the other times. So what is your real market structure shift? How do you know the market structure shift happened? When you look at the last lower high, if it gets taken out like it did here, you should change your bias to bearish, which means you're not looking for longs, you are looking for shorts. Okay, so right here we create an equal lows, which means that you could anticipate it being already taken out, because sometime or another it will be taken out. Okay, so right here we have an energetic displacement to the downside, which it bounces off another level and takes out buy side liquidity. That's your entry down to the last low. That's it. As you can see, that's it. Okay, so this pattern combined with time and price theory and market structure and fair value gaps, man, that's all you need. Trust me, guys. This is one of the ICT's main pattern, so-called pattern, because right, retail traders only retail traders use pattern. I mean, what the heck is a institutional trader, smartman trader does with patterns, right? That's the whole point, to ignore patterns, because the so-called retail patterns are made so that the institutions know what retail does, so they can fool them and take away their money in order to profit even more. That's it. Okay guys, I hope it was insightful. See you in the next video.